May 2024 financial reporting full detailed answer I have given here. The file link, PDF link have been given in the description also. If you want, you can download and verify. So as far as first question, consolidation is concerned, a very simple question only. But the problem is already this question is not there. That is the problem. So otherwise, if you see the answer, it will be very much easy because all the concepts are there in different sums. So everything have been consolidated. That is the problem here. Correct. So here, first bonus is declared. Dividend is declared by holding company. This will be appearing in other current liabilities. For current year, other current liabilities 50,000 will come. And bonus declared by associate, 40% we have to account as dividend receivable. And this profit and loss account balance will be reduced to the extent of dividend declared, 15,000. And S Limited, total dividend declared, 2 lakh will not be accounted because subsidiary is giving to the parent. Intercompany transaction ignored. For example, here I have given that in working note number 3. So to the extent of 70%, we have to we should not account. Only 30% should be accounted as dividend payable. So total dividend payable in the consolidated balance sheet will be 50,000 for holding company. 30% of the total dividend should be declared, disclosed. So 56,000 will come as dividend payable. Then bonus is also not accounted. Bonus is not eligible for dividend unless otherwise given, because current year end only they are giving dividend and bonus also. So normally dividend is not applicable for bonus shares. So only for 2 lakh shares, already existing shares only dividend should be declared, and bonus should be given from retained earnings. So I am deducting here. So if you deduct the balance available on the date of acquisition, so please remember, somebody will think that October, June, like that they have given. So that total post-acquisition profit we have to subdivide based on time proportion basis. No such confusion. Clearly they have given on the date of acquisition reserve balance they have given. Correct? So straight question, simple question as far as this is concerned. So but opening balance on the date of acquisition, bonus we have to reduce. 4 lakh we have to reduce. So you will get post-acquisition profit. Then goodwill or capital reserve for subsidiary and associate. We have computed. Then post-acquisition profit of S Limited, 70% we have to add with my profit and loss account, head office profit and loss account, 30% non-controlling interest. Like that, I have added 40% of the post-acquisition profit of associate also I have added. And they have specifically given goodwill of subsidiary is impaired. So goodwill we have to eliminate and we have to write off from the post-acquisition profit of subsidiary. So 70,000 goodwill I have eliminated. And in A Limited, we are not having any goodwill. Capital reserve only we are getting. So if you prepare, then one more important point here, that is investments in A Limited. How to compute this? Net assets taken over on the date of acquisition as per working note number 3, 1,10,000 less capital reserve, you will get consideration transfer. Then post-acquisition profit 40% I am adding. Very important point, stock reserve 40% of the profit element, closing stock reserve I should deduct from the investment as well as stock. Investment I have to reduce. That is associate total assets 40% I am accounting. Correct? So total assets of the inventory, total assets of associate include inventory. That inventory include profit. So in asset side, investment I am reducing 40%. And since this profit is made by holding company profit and loss account, I am deducting 4,000. So in consolidated profit and loss account, I am deducting the stock reserve of 4,000. H Limited sold goods to associate. H Limited sold goods to associate. So associate inventory will have profit. Holding company profit and loss account will have profit. Both I am reducing. Clear? Like that, trade receivable of associate is there. That is also asset. So associate asset 40% I have already taken. For that, I'm reducing 40% in the investment side, and to that same extent, holding company will have trade payable. That also I have to reduce to the extent of 40%. So trade payable I have to reduce, mutual owings, not entire mutual owings, 40%. To that extent, here also I have to eliminate. And dividend declared by associate will be deducted from the investment and shown as a separate dividend receivable in balance sheet. So consolidated balance sheet la goodwill will not come. Investment in associate as per that working note it will come. Then dividend receivable from A. So apart from the given asset, extra one asset will come. 40% of the dividend receivable from associate. So this is there some, you can just go through. And I already told that this question, straight question, no change, only numbers are changing. So straight question only. This is also straight question, whether that carve out principle. After the balance sheet agreement has been entered, so it is not taken into consideration. So it should be treated as current assets, current liability only. And here, very simple. First, we have to find out the carrying amount of the lease liability. What is the carrying amount of the lease liability? And we have to rework for the modified lease liability for 8 years. Actually, 10 years, 6 years over, na, remaining 4 years only will be there. But again, another 4 years. So 4 plus 4, 8 years. We have to account for the revised modified lease liability. And the difference should be added to the ROU asset. So ROU asset accounted are to lease liability. That entry will be passed. And financial compound financial instrument, already you know, present value of the interest and present value of the principal should be treated as a liability component. Total consideration received 320 minus this liability component will be accounted as equity component. And the beginning opening balance will be this liability component, and we have to add notional interest. Market rate we have discounted, correct? So market rate interest we have to provide, but actual cash outflow will be at 8% only. So this is the actual cash outflow. So opening balance plus notional interest minus actual payment. This notional interest will be the finance cost to be debited to profit and loss account. So that question is also answered. This question also I already told, a straight question only. So already it is there. Termination benefit, gain on settlement, that also you have to compute. That is this point, everybody will think that it is very difficult. No, sir, it is very simple point. That is due to the redundancy. Redundancy means some of the employees are going out. Correct. At that time, what I'm doing now, payment made 36,270 payment has been made. By paying this much payment, my obligation reduced by 38,390. Correct. So what I have to do now, investment, I have given as a crux. In study material only this answer have been given, so I have given. Sometimes you can prepare plan assets separate ledger account and defined benefit obligation separate ledger account you can prepare. At that time, benefits paid will be 36,270. Correct. So benefits paid will come in plan assets credit sale, because benefits will be paid by selling the asset. Sale of the asset will come in the credit side. So 36,270 you have to credit in plan assets, and defined benefit obligation reduction of obligation. So obligation already credit balance is there. To reduce you have to debit. So benefits paid 36,270, like that here also benefits paid 36,270. But by paying 36,270, my obligation reduced by 38,390. So my gain on settlement is what? 2,000 to 2,120, which is nothing but 38,390 minus 36,270. By paying 36, you are reducing your liability by 38. So that gain will also be reduction in defined benefit obligation. So already credit balance is there. To reduce that, you have to debit. So plan assets credit will be 36,270. Defined benefit obligation debit 36,270 and 2,120. Correct? So this is the net effect. You can also prepare plan assets separately, defined benefit obligation separately you can account. So this gain on settlement will come in what is that? Defined benefit obligation account and profit and loss account. Net finance cost will also come in profit and loss account. Current service cost, past service cost, profit and loss account. Balancing figure remeasurement loss will come in the OCI. Correct? Then India is 20. Straight question only. Here in the ratio of expenses, you have to transfer the grant received. Total grant received will be 6 lakhs. In the ratio of expenses, what is the expenses ratio? Here I have given total 6 lakhs. Receivable in 411. This ratio is not relevant. Cost is relevant. Recruitment cost plus first year wages bill. So 11 lakh 60. Then this wage bill will increase by 80,000 every year. So 8 lakh 80, 9 lakh 60. So now in this ratio, 1160, 880, 960. In this ratio, I have to transfer 6 lakhs to the profit and loss account. Balance will be disclosed as deferred income in balance sheet. Okay. Then India is 115, straight only. So you have sold for 1,500 and the expected discount is that 25% only you have to take, because 30% already 5% discount is there. So 25% incremental discount only you have to allocate. And your expected purchases is 1,000. In future you will get 1,000. So 1,000 average purchases into 25%, and you are having 80% probability that customer will come. So total standalone selling price will be 1,500 for the product, and next year next purchases 200 discount. So 1,700 is the standalone selling price. Transaction price 1,500. 1,500 should be allocated in this ratio. 1,500 is to 200. In that ratio, you have to allocate. And here, India is 101 option. That is, you can continue capitalizing the forex loss. That option I'm not allowing, not availing. In that situation, what I have to do? Already capitalized cost, you need not to do anything. Further, in future, whatever loss is coming, that you have to debit to profit and loss account. That's it. Then these are all straight theory questions. I have given the reference page reference of Paduka material. And last question, India is 105. Straight question only. So that is now the recoverable amount after recognizing. I will just explain this itself. Carrying amount before impairment is 26 lakhs. Carrying amount before impairment. So first impairment loss, recoverable amount is to 2350 only. So that impairment loss, I think there is some error. So impairment loss will be 26 lakhs minus 2350. That will be the recoverable amount. And impairment loss will be this difference. And it should be first time when you are classifying it as held for sale, we have to account as fair value less cost of disposal. So fair value less cost of disposal 2350, 23 lakh. So 23 lakh will be the initial classification as held for sale. Total charge to P&L, that will also be yes. Here there is a mistake. 2,50,000. This is 2,50,000, and additionally 50,000 is there. So total 3 lakh. Correct. This is correct, but here 2 lakh some typo error is there. So here it should be 2,50,000, because the difference between 26 and 23,50,000 is 2,50,000. Impairment loss and loss on reclassification 50,000. So totally charge to P&L will be 3 lakh. If depreciation, if it is not classified as held for sale, what will be my revised depreciation? That I have to compute. So after 1 year, if I have not classified it as held for sale, what will be my carrying amount? 21,69,000. Now the recoverable amount, even though it is 25, I cannot reverse to the extent of 25. I can reverse only 21,69,000. I can reverse. So now the carrying amount is 23. And I have to reduce it to 2169. So this difference charge to P&L will be this difference. That is 23 lakh minus 2169. Okay. That's it.